Probably the most interesting thing that is happening in the stock market today, or the stock markets, because there's different markets, is what's not happening. The S&P 2 months ago broke out of its 24-month channel and has been doing nothing. The federal funds rate was increased 0.25% back in December of last year, and since then it's done nothing. Interest rates are kind of just hanging out right now for the most part. Not much is going on. At least here in the United States, there is a presidential election coming up. Within a month, in the next 30 days, we will know who the next president is of the United States. It's going to be either someone who's, maybe they're both very hated, but it's going to be someone that half the country really doesn't like. And everything that I can tell, as absurd as it may be to people, especially who live outside of the United States, it is a dead heat right now. There is no leader. There is no clear winner. It can go either way right now, literally 31 days before election happens in this country. And the world does not know if it's going to be, Hillary Clinton or little Donnie. But we will know in 31 days. And it's very likely that the market is waiting to see who is going to be that person. And I mean a lot of the markets, but the most important market I'm talking about is the stock market. And we're seeing that a lot. But with that going on, the thing that really stood out to me the most this week was not what's not happening, but something that's going on by three entities. And I think it's really important because it absolutely affects all of us. And that's what I want to talk with you about. Hey everybody, this is RC Peck, and this is my weekend podcast, and it's so good to have you here. And the theme this weekend, the theme that we're going to look at is there's three key players, and there are three central banks: the European Central Bank, the Bank of Japan, and the Fed. There is the Central Bank of the UK, and there's the Central Bank of China. But we're going to look really at those three major central banks, and specifically we're going to look at the biggest on the planet, which is the Fed, the one in the US. And I want to start with where they are right now because it's really interesting. And the reason I'm bringing this up is because gold has had a correction lower, and it's been a pretty severe correction. And there's lots of talk that the reason why gold is going lower is because gold cannot go higher as interest rates rise, right? As the federal funds rate goes higher, gold is going to get crushed. So whenever I hear that, and I've been hearing that a lot lately, the question is that actually true? Does the evidence back up people's belief system? And so we're going to talk about that. Now, before we talk about that, I want you to look at this image, and this is an image of the federal funds rate going back 2 decades. So we have 2 decades of information, and the green line is what the federal funds rate is at, right? And so you can see that line going up and down. Now, on the screen, I have 3 reddish-orange vertical sections, and those represent when the Fed raised rates. Because there's a lot of talk lately about, well, if the Fed raises rates, then stocks are going to crash. If the Fed raises rates, then bonds are going to crash. If the Fed raises rates, then gold is going to crash. Okay, well, let's look at some of those, and let's see what's been going on the last decade to see if that's true. Now, before we get that, I want to point out to you that during a recession, and in this country, there's been a recession in this country on average every 6.5 years. And this goes back to the 40s. So we have, what is that, 60, 75 years of data that says there's a recession about every 6.5 years. We have not had a recession for 7 years. So we're past the average. We also know the longest time we've ever gone without a recession is 9.5 years. And even if you wanted to round it up, you could round it up to 10. So that's the longest. Doesn't mean we can't go longer. It just means so far the last 75 years, this country has not had a recession, has not gone between recessions more than 9.5 years. We also know that there's been 11 recessions since World War II. And we also know that the average length of a recession is 12 months. That's the average length. The shortest one ever has been 6 months. That was in 1980. And the longest one ever was the one back in 2008 and 2009. That was 18 months. So I'm loading this up for you so you understand. The Fed has a very clear history that they cut rates during a recession. The smallest cut they've ever done is 2%, and the biggest cut they've ever done is 10%. And these are percentage points, right? So they have a history of always cutting. There's never been a recession where the Fed did not cut, right? So whether it's a 2% cut or a 10% cut, they're going to cut based on history. And on average, that cut is somewhere between 4 and 5%. So if you take the fact that today the federal funds rate is pegged at 0.5%, okay, and maybe they'll raise it another 0.25% next month to 0.75, right? Maybe they might even raise it another 0.25% 6 months or 12 months after that. We don't know. But maybe we'll get to 1 percentage point. 1 percentage point. And we know that the Fed always drops rates in a recession. Now, I don't think it's likely the Fed could raise rates past 1 percentage point. All right, so let's say they did, which to many people think that's not even going to happen. I mean, heck, they only raised 0.25% in December of last year, 10 months ago, and the rest of it's just been talk. Well, we're really thinking about it. So if we did get to 1% before the recession, we know that rates will probably go negative. I know that sounds absurd, negative rates in the United States, but based on history, that's what we're going to have. And the only reason why we wouldn't have it is if the Fed increased rates to 2 or 3 percentage points, right? Raised it up to that, and then dropped it 2 or 3% back to zero. But it seems very unlikely that they will actually raise it up to 2 or 3%. Even by their own standards, they say they won't. So that's what we're moving into, guys. It's pretty incredible. Okay, so let's look at the federal funds rate and let's compare it against gold. So in this price, on the top part of this price chart is the federal funds rate, and below is gold. So when gold, and we are in something what I call a contraction cycle, which means you should not have been in gold between 1982 to 2000. But let me set that aside for a second. So the last time in the last 20 years, or actually, let's go back to the first time in the last 20 years where the Fed raised rates. They raised rates between the year 1999, halfway through the year 2000. And they did that. And when they did that, gold started that at that time period being worth about $280 an ounce. And by the time the Fed was done raising rates, gold was worth about $270. So gold fell about $10 from the beginning to the end of that rate rise. So let's just call it neutral. The second time the Fed raised rates was from mid-2004 to mid-2006. Now, during that time period, gold went from about $400 to about $650. So during that time period, gold went up about 65%. So that time, gold went up 65% when they raised rates. And the most recent time is this past December, where the Fed increased rates 0.25%. And since the Fed raised rates 0.25%, gold has gone from $1,040 an ounce, peaked above $1,300, and today let's just call it $1,240. So it's gone up $200 or about 15%. So at least based on evidence over the last 2 decades, gold either goes up significantly or it just kind of chops sideways. So this idea that if the Fed raises rates, gold's going to get slammed, it could be different this time. But based on what has happened the last 2 decades, it looks like either gold will just shrug it off like, or gold will go higher. Okay, so that's gold. And before we move on to the next one, I put in a red vertical line just to show you when we moved into the contraction cycle back in November of 2000. So even when gold went sideways between 99 and mid-2000 when the Fed increased rates, you would never have wanted to be in gold anyway because we were not in a contraction cycle. Okay, and if you don't know what that means, that's fine. So now this price chart compares the Fed with the 30-year U.S. bond. Okay, it's showing you the price of the 30-year U.S. bond. Okay, and you can see back from 99 to mid-2000 when the Fed increased rates, the 30-year price fell. It fell from about 107 and it fell all the way down to, let's just call it 100. So it fell about 7% from a price point of view. And then when the Fed raised rates in mid-04 to mid-06, right, Basically, the 30-year Treasury, it went up a little bit. It went up about 0.5%. It went up about 0.5% the last time the Fed increased rates in a significant way. And then we go back to December, the most recent time, where the Fed increased by 0.25%, and the 30-year bond price went up. It went from 165. I mean, it didn't go up that much. About 162, I'm actually looking at this. Went from about 162, and where it is today, it's about 165. So it went up. So when you say that the Fed raising rates is going to crush bond prices, at least the 30-year bond, it hasn't done that. And I don't even want to say it hasn't done that. Yeah, just it hasn't done that. And the last thing I want to show you is the S&P 500. And during the last 3 rate hikes back in 99 to 2000, when rates were hiked, the stock market went up. Back in mid-2004 to mid-2006, the stock market went up. And this most recent one, the stock market went up. So at least over the last 2 decades, every time the Fed has increased rates, the stock market saw that as, all right, that's good. And so far, we've even experienced that because we raised rates in December. Yes, there was kind of a throw up of sorts of the market, but then it just got right back up and moved to new highs. So the evidence is telling us that an interest rate increase will not hurt stocks, will not hurt bond price, and will not hurt gold. Now, I did say at the beginning, they can't raise it too much because then it will hurt, because one of the reasons why the stock market is going up is because the Fed has lowered rates all over the place and people are not getting any money these days to put money in bonds or savings, and so they're being forced to put into the stock market. So look, that could affect it. But based on what's happening today, not what will happen or what might happen, but based on what's happened over the last 2 decades, I've just given you the actual evidence of what's happening. So the question is, what is the takeaway? What do you do with this information? So the first thing is follow the price first. Follow the price first. I just showed you those 3 charts showing you the actual price of the 3 major assets on this planet. And, over the last 2 decades, they have acted in a way that you would not have thought. So follow the price. Follow history. Now, it may be different this time, probably not, but follow what has happened in history. And I've gone back 120 years and I've looked at all the contraction cycles, which we are in right now. Follow history. History repeats itself. Heroic government intervention. This is not the first time. Right? Unprecedented government intervention. This is not the first time. Manipulation. This is not the first time. These are things that happen during contraction cycles. You can follow the fundamentals. So look at gold. Gold has been hit hard the last 2 weeks. Have the fundamentals changed? And the answer is no, they haven't. The sell-off in gold very much looks like there's been maybe some sort of like margin desk liquidation. Like maybe there was a large gold position by a very large hedge fund or sovereign debt fund, and they've had to liquidate. They didn't want to liquidate, but the margin desk liquidated their position because the way that gold and silver has fallen, silver has probably fallen in sentiment of gold falling. That's more of like a liquidation. Someone had to liquidate their position. That is not someone liquidating their position for profit. So I have not seen the fundamentals change. The fundamentals have not changed. Even if the Fed does raise rates, which I believe they should, I don't believe they are going to be able to raise them more or any higher than 1%, 1%. I don't see that right now. They're at 0.5%. So maybe they do one more this December. So they would have done one this December. They would have done one last December. So they can kind of save some face and say, yeah, we did one this year. Yeah, we'll do some more next year. And, they'll see what happens. That's very likely. But, make sure if the price falls, obviously you need to follow your strategies, which is the last thing. Follow your strategy, right? So if the price is falling, okay, but did it fall to alert or signal to do a change in your strategy? And that's why you have a strategy that knows when the downside is hit, that knows when you should step aside, that knows when you say, look, my assumptions are wrong. Let me step aside and reevaluate my assumptions. But you want to follow history. You want to follow fundamentals. You want to follow the strategy, and you want to follow price first. And when you do, you align yourself to the market. You align yourself to history. You align yourself to price. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, thank you so much for being in my world. I love it. I love what I do. Sometimes I think like, yeah, if I was retired, this is what I would do. If I was 65 and worked for GM my whole life, man, I would start this up and this is what I would do. And so I'm so thankful that I'm able to deliver my information to you and my point of view to you and really cut through the noise and just show you what the evidence is. And I know that hype sells and I know that fear-mongering sells because of the way that the human brain is designed, but that's hurting people's portfolios. It's hurting their futures. Hey guys, I'm reestablishing my blog, so I'm going to start posting these to my blog where there will be like buttons and all the stuff that other people have been doing for years. So when that is set up, I will ask you to like these videos to start getting the word out and start spreading the word because that will make a difference to me and it will make a difference to the people that you spread and you share this information with. So thank you all. Have a great weekend, and I'll talk to you next week.